It's time for the Your Personal Bank Show with Ferenc Toth, president and founder of Secure Estate Management. Take charge of your financial future with your personal bank. Now, here's Ferenc Toth.
Welcome to the Your Personal Bank Show. Anyway, it's been fun talking to folks lately. Been running into a lot of situations, a lot of interest, and talking to a lot of new existing and new clients. Okay, about the personal bank tool, using the positive arbitrage. Basically creating positive arbitrage on your money. And really, like I said, it's really quite simple. This is a concept I'm going to tell you right off the bat that very, very few people are familiar with. Some people are familiar with what they call the insurance banking concept and different things like that. But this is another step beyond that. And that's what I want you to understand. And I've been talking to, actually, it's kind of fun. The last few weeks, literally, I've talked to a bank manager, branch manager, mortgage expert, shared with him what we're doing. Super excited. In fact, looks like he'll become a new client, meeting with him and his wife, actually, personally. I was reached out also by, last week, a professor of finance, one of the Ivy League schools. I'll just say keep it at that for now. He's extremely excited about sharing, this whole concept. He goes, I've never heard anything like this. This is incredible. You've taken it to another level. I said, thank you. We're in discussions about what we're going to do further. Maybe become we'll see. But my point is, finance professors, people in the banking industry, mortgage folks that understand money are, of course, and just normal everyday folks, clients, business owners, whatever it may be. When I share with them this tool, and it's very straightforward. I mean, literally, I just lay it out there, and then people go, "Wow, that just makes sense." And the reason why we came up with it, I'll share that a little bit further. But really, what is the tool? Again, it makes financial sense. It's really, it's the simplicity of it that it's really cool. It just makes it awesome to understand quickly and grasp and understand so many different scenarios and situations where it can enhance somebody's financial future. Okay, and really, here's what it is. This is it. It's really quite simple. We set up a high cash value policy. Now, this isn't the type of insurance policy most people are familiar with. This is where, when somebody misses the point, this is it. This is the point where they just don't get it, okay? Or they struggle. Because I've heard this from a number of folks who've contacted me, and I kind of have to, I share with them. I say, look, the struggle you're having is it's been so ingrained in your thought process, or you've heard this so many times, that insurance is basically not an investment. It's a death benefit protection tool and should be used for that. In fact, there was the popular mantra. I don't hear it as much anymore these days, but it was really popular for quite some time, was buy term, invest the rest. Most of us have heard that. Unfortunately, the statistics have shown, for the most part, they didn't work very well. But the reality is, that's beside the point. We don't need to argue that point. It's just ingrained people into thinking, basically, if you're going to buy insurance, what do? You shop it around, you find the cheapest price, the least premium you can pay to create the largest death benefit. And really, what I say to people all the time is this. When I'm doing a workshop, I love doing this, and when I'm doing workshops in groups, it's fun. Of course, I haven't done one recently, obviously, but I'll say, how many folks in the room have having life insurance? And I'll get half to 2/3 of the hands go up typically. And I'll say, no, you don't. And they look at me, and it's kind of funny. There's usually like a uncomfortable pause. I've even had some people start to argue with me a little bit. I'll say, no, you don't have life insurance. What you actually have is death benefit protection. And then the light bulb starts to come on. Again, it's being used as a death benefit protection tool. And there's nothing wrong with that. I'm not picking on that. In fact, lots of people, in fact, the statistics show, and of course, people I meet with, it's very common, are vastly underinsured. In other words, if something happened to them, their loved ones would be in a financial pickle. Okay, so if you have loved ones, you have business, you have death benefit protection needs. Okay, you should take care of those, and that can be done typically very inexpensively. Many times through term insurance options that are out there. There's tremendous numbers of them out there. We can show you what's out there, and very inexpensively take care of that need. But when we're talking about the Your Personal Bank concept and maximizing cash, that is not what I'm discussing. we're actually using a very specialized type of insurance financial product. It's high cash value policy. It's designed to maximize cash value, maximize dividends. We have companies that have paid 6% dividends every year for the last 25 years. I'll show you the charts. I have charts that go back 25 years on all the major dividend-paying companies out there. And it shows you what they've actually paid. This was put together, by the way, not by the insurance industry, but by the lending industry. The banks that lend, that borrow, use the cash in these policies from lines of credit. See, where I came across all this was I realized, wait a minute, who is looking at these policies closer than anyone, analyzing them? No one's looking at them closer than the banks who are using them as collateral for loans. And by the way, they're not willing to loan with this any company and any product, by the way. That should tell you something. They're looking at ratings and cash reserves and history of dividends and all the leadership and all those kinds of things. And the thing is, they're willing to put their money behind it, right? You should pay attention. If a bank is willing to put their money on it, on the line, in other words, use the cash value of that policy as collateral for a loan versus another company they're not, you should pay attention to that. There's reasons, okay? There's reasons why. So I asked the banks, I asked the lenders. And by the way, this is a very specialized area of lending. It's not like you can go to your local bank or all the big names, the ABCs that we know, the banks out there, they don't do it. There's a very select group, specific, and we'll connect you with the right banks who have the best rates available based on your situation. But the rates today are as low as 3%. And we can get 3% for most of our folks. By the way, if you were listening a minute ago, I told you they're paying 6%, have been paying 6%, the policies, 25 years in a row plus, never missed dividends since before the Civil War. If you're earning 6%, you're getting paid 6%, and you're getting charged 3%, what's going on with your money? By the way, you accessed and used it, didn't you? And you're still picking up 3% positive arbitrage. Think about that for a minute. This is a tremendously powerful tool. You can use those dollars for whatever purpose you want. It's your money. So can you pay off debt? Can you reduce the borrowing costs, for example, on loans? Could you purchase items? Could you pay cash for something and pick up 3% interest on the money you spent on a car or any other big ticket item? Could you take the monies and reinvest it into assets or investments that you like and pick up the 3% positive arbitrage? See, I have a lot of real estate investors that do this, stock market investors, cryptocurrencies, precious metals, just about anything you can think of. And my point is this. I'm agnostic in terms of what you invest in. It doesn't really matter to me. All we're doing is enhancing whatever you're doing. See, I'm not I'm not the competition. And again, I'm hopeful over time. There's some advisors out there that understand that and I work with, and I'm kind of like the specialist they recommend me to. Unfortunately, that's the minority. But hopefully at some point, eventually, more and more will come to understand this, that, gosh, we could bring this to the table for a client and pick up another 3% return. Or a client, somebody can come to me and talk to me about it, and I can pick up show you how to pick up another 3% return on your investments. Now, I don't know about you, but for most people I meet with, an extra 3% return on investment is huge, whether you're an individual or a business or whatever. You know, somebody tells me I'm making 7% returns. I say, would you like to make 10? That's a significant increase, percentage-wise, of what your returns are. Stay tuned in the next segment. We're going to talk about this a little further and why, in what situations, you should look into this. Stay tuned.
For more information on your personal bank, call Ference at 866-515-6280 or online at yourpersonalbank.com. Back to Your Personal Bank Show with President and Founder of Secure Estate Management, Ference Toth.
Welcome back to Your Personal Bank Show. Again, I've been talking a lot about, if you listen to the show Tuesday, I talked a lot about the reasons behind the type of situations. You know, folks should look at the personal bank concept. And I was just sharing in the last segment a little bit about how it works. But it's kind of funny. And like I said, if you missed that or whatever, go to yourpersonalbank.com. You can listen to any of the previous shows on this concept, on this tool, how it works. Contact us there for any additional information. I'll be happy to talk to you. You'll be talking to me. When he educates you, basically, look at your situation, educate you on how this would work and how it would enhance your situation. Whether you're looking to diversify, increase returns, increase liquidity, reduce borrowing costs, okay, reduce taxes. You want to take care of some or protect yourself against living benefits, like medical expenses, long-term care, terminal, those kinds of things. Or you want to maximize your family legacy, pass on to the next generation. Those are all, or a combination of those things. Your personal bank really can enhance your goals. And the thing is, I find it's kind of funny. We're kind of creatures of habit. And it's amazing how used to we as human beings get used to a situation and we get comfortable with that situation. And often we don't look at other alternatives, even when we come across something like this that maybe we're not as familiar with or been exposed to or whatever, and we tend to, not do anything about it, or, cursory look at it a little bit and, come up with some reason, it's not worth it, or I don't want to bother with that or anything like that. It's those times of crisis or change situations that force us to make those changes. I run into that all the time with clients that contact me. Often it's because something's happened. There's been a change in their situation, in their life, their lifestyle, their financial situation, or any number of things. Okay. That's when they start looking at alternatives. I've got to give a shout out to kind of my engineer types, the analytical folks. It's funny, and I find that they're the ones a little bit more willing to look at and analyze and look at something that maybe isn't necessarily part of their wheelhouse or comfort zone, despite the fact they may or may not be under a crisis. I deal with a lot of engineers, believe it or not. It's kind of funny because they look at this, they analyze it, they crunch the numbers, do we do the spreadsheets, all that fun stuff, and they come to the conclusion in most cases, I can tell you in the vast majority of cases, makes sense. When you can add positive arbitrage to your situation, you can increase your rate of return. You can add safety into the equation, at least on a portion of your dollars. You can reduce your taxes, again, at least on a portion of your dollars. The numbers don't lie. It just works, and the numbers speak for themselves. I tell people this all the time. Look, you don't have to like me. I mean, we'll have a positive professional relationship. It's usually, pleasant. But the reality is you don't have to like me or trust me. Let the numbers speak. And that's what we do. We compare numbers. We look at the situation. And it just makes logical sense. Okay? And some of the things I hear about from folks all the time is, I'm older or this kind of thing. Insurance. You're talking about insurance. It's beyond my time. I'm too old and things like that. Well, here's the thing that folks need to understand. Remember, this isn't the traditional use of life insurance, okay? We're not doing this to maximize death benefit. Yes, there is one, but we're doing this to maximize cash growth. Now, immediately, I've shared this several times, usually your cash available is anywhere upwards of 50% plus to 90% plus cash value available day one. We're minimizing the death benefit by those same percentages. So we're cutting the death benefit in half to upwards of 90%. I had one client, it was so funny. He talked to his financial advisor. He came back to me, and this is a very common question I get. It's, two of them. One is age. All right, let's hit that one, then we'll hit the other one. I'm too old. I'm in my 60s. I'm in my 70s. By the way, folks, I've successfully done these cases on folks up to age 79, and the numbers work, okay? Now, granted, the 79-year-old was relatively healthy, not super healthy, but, if you're going to be 70 plus, you have to have some health on your side, be relatively healthy. But if you're younger, more flexibility in that. But the numbers still work. You still get the positive arbitrage. You still get, it still makes sense. And the cost of insurance and stuff is not nearly as much as you think because, again, we're maximizing cash. We're not maximizing death benefit. So I was running some numbers for a gentleman the other day recently and looking at putting it on by the way, if the numbers don't work, we can always use your kids or other family members or business associates, things like that. Key person. We do that all the time. So if health or age is not in your favor, you can still own one of these, still pick up the positive arbitrage, the cash growth, the tax benefits, all the other stuff we talk about. It's just somebody else is the insured. You're the owner. You control the money. Well, anyway, this gentleman, he's late 60s and very successful CFO. And he was looking at doing this on himself or his kids. His kids were like early 30s. He's late 60s, okay? And we ran the cash numbers and everything. And interestingly enough, comparing him versus his kids, the amount of cash growth between him and his kids was such a little difference that he decided to do it on himself. Yes, there was a little bit more cash with the kids, but it was so minor, the difference. We're talking a couple percentage points difference, literally, over like 20-year period, that it just wasn't, the difference wasn't enough to put it on the kids. It made more sense to do it on himself because of the other benefits, the living benefits, the chronic, critical, terminal, living, long-term care stuff, okay? And the death benefit that would go to his wife if something happened to him, right? Tax-free. So those outweigh that small percentage difference of the cash. We'll look at it both ways. No question. But my point is, we're going to go into it with your eyes open. You're going to see and know which makes more sense. So he was surprised. He was like, wow, I thought, it'd be, the difference would be a lot, between me and my kids. I'm late 60s or early 30s. One was 20, almost not even 30. And he was surprised how little the difference really was. So that's what I'm saying. Just because you're in your 60s, even 70s, don't discount this and think, oh my gosh, this is past me. It's not. Okay. And then the other one that I hear often is, what we get paid. Okay. Commissions and things like that. Now that's an interesting one because one of my clients, he talked to his financial advisor. He's like, okay, everything kind of makes sense. The numbers make sense, but wanted me to ask you, commissions, what are you getting paid for all of this, right? Well, in his case, we were front loading. We were doing a chunk of money up front. So the cash available in his case was 90%, which means we were reducing the death benefit by 90% of what it would be from a traditional policy. And primarily how we as agents get paid is based on the death benefit. So the bottom line was it reduced my commission by 90% in his case. And he goes, I see that. And I said, now that wasn't being mean, but I said, ask any other financial advisor person, are they willing to reduce their fees or commissions or whatever by 90%? He goes, and he just laughed. My point is, when we're structuring these things, it's the cash, maximizing the cash, maximizes the benefit to the client, okay? There's only so many ways to cut a pie. You know what I'm saying? The company can only pay so much. The more cash we give to you, cash side, obviously that's taking away from the agent. And I've had agents who've worked for me for years, decades even, who chose not to go that route and left the company because they weren't willing to take that commission reduction, okay? Now, my point to them was, look, if you're going to maximize cash for people, you're going to have a whole lot more clients, which is what we do. So stay tuned. We'll talk about this further in the next segment.
For more information on your personal bank, call Ference at 866-515-6280 or online at yourpersonalbank.com. Back to Your Personal Bank Show with President and Founder of Secure Estate Management, Ference Toth.
Welcome back. We're talking a lot about the personal bank concept, kind of how it works, who should consider looking at it, what type of situations that this makes a lot of sense for. And like I said, it's really quite simple. It's not a complicated concept. Some people try to make it out to be. It's not. It's really simple. We set up a high cash value policy to maximize cash growth. It's not the kind of policy most people are familiar with. We got companies that are paying 6% dividends, half for the 6% plus, half for the last 25 years plus. I'll show you the charts. You'll know immediately which companies you want to work with. It's really quite simple. And this is from the financial industry, the banking industry, actually. And there's a certain group of banks that will offer a line of credit using the cash in the policy as collateral. Current rates, like I said, earning 6, crediting 6 in the policy, access 3% bank line of credit. We have variable lines, fixed lines. Okay, so you can create a positive arbitrage situation or lock in a positive arbitrage situation on your money. Why this is so important? How this can be used? It can be used in a number of different ways. It can be used as a diversification tool. Having a non-correlated asset. Have something that is not related to the markets, for example. Or if you're a real estate investor and everything's in real estate, you've got something that's not related to the real estate market. Or you could say that about cryptocurrencies or precious metals or any other asset class for that matter. Okay? Having something that's diversified, something different. And again, we're how should I say? We're creatures of habit. We get in a comfort zone. We get familiar with something. We get used to it. We get comfortable. And when things go wrong, things go bad. And if we've overcommitted or overexposed ourselves in one area or another to risk, that can be detrimental. That's why diversification is so important, particularly non-correlated. Okay. And the thing is, people are reluctant in many cases to go into another area that's totally unrelated, frankly, because they're not familiar with it. It's an area of, they're familiar with what they're doing, but they don't know about that other area. So if you're in the markets, you may not be that familiar with real estate investing or vice versa, for example. Well, the nice part about this is everything has guarantees. Your principal's guaranteed, and no matter what option we choose. And if you just want to be, we can go the conservative 6%, steady, consistent every year, last 25 years in a row. Plan to keep going that way and have been doing that, been paying dividends every year since before the Civil War. There's not a lot to understand there. It's not hard to grasp or understand what's going on. You put the money in there, it grows consistently with guarantees and tax benefits. Okay? So you got that consistency, that steady. So don't let the unfamiliarity, I think I said that right. Don't let that cause you to not take a look at this, because it can really tremendously enhance your financial situation. Again, you can increase your returns by that positive arbitrage, like I said. If you're getting a 10% rate of return on your investments, whatever that may be, do you want 13? What you just did there is you increased your rate of return by 30% in that scenario. A 30% increase of rate of return is huge for just about any individual or business for that matter. Okay? Make a huge difference. You can increase liquidity. You can have you'll have access to more funds and yet not have to lose the future gains. As we all understand, and just about any financial investment, if you access funds from it, you spend the money, the returns on the money you spend is gone, right? You spent it, it's gone. Here, I like to say to folks all the time, put it in there, make 6. Access it, still get 3. So your money's still growing for you, even though you're using it for other purposes. And that's real life. We all have expenses. We all have things that we want and need that we buy. Why not pick up? One of the statements I say to folks all the time is, why not pick up 2 or 3% on money that you spend? Think about all the dollars that go out the door on a regular basis every month, individually or business-wise. What if you could pick up 2 or 3% on that? And then you do that for the next decade or 2 or 3 or more maybe. What kind of money are we talking about now? Some big dollars, okay? So we can reduce borrowing costs, finance costs. If you were going to take a car loan, you want to reduce the interest rate by 3%, or a mortgage, or any other type of financing. The personal bank can accomplish that for you too. You can reduce taxes, okay? A lot of people fund qualified plans and things like that to reduce current taxes, but then that creates future tax liabilities that are uncertain. I say this to folks all the time, particularly your higher income earners that are putting a bunch of monies into qualified plans, IRAs, 401ks, pension plans, various things. Can you tell me when you retire, when you're going to access these funds, can you tell me what the tax rates are going to be? We don't know. And many people are concerned about them being higher with the federal debt and things like that. So if you're deferring now and the rates are higher in the future, what are you doing to yourself? You got to consider that. And by the way, if those qualified plans, those monies grow, you've just created a bigger tax liability, haven't you? Because there's more money. So if you've got a bigger pile of money to get taxed on, and the future rates on top of that end up being higher, you've actually caused yourself a lot more in tax than you would have just addressing the tax liability now and letting the money grow tax-free. That's the argument between traditional IRAs and Roths, for example. Okay? So having some of both, in many cases, makes a lot of sense, because then what does that do? Gives you options for the future, right? Which bucket do I pull my money out of, depending on the tax scenario, right? A lot of people are concerned about medical expenses, critical, chronic, terminal, long-term care, those kinds of things. Some people purchase insurance policies, long-term care policies, things like that. Unfortunately, in many cases, those can get pretty expensive, especially over time. Many of those policies, the premiums, the contributions increase over time, and they can get cost prohibitive. I see that very, very commonly, by the way. I've seen many of those situations where it's really sad. Now a couple is in their, they're getting in their 60s and 70s even, and maybe they got one of these policies a decade or two ago. They've been contributing to them diligently all this time, and now they're getting rate increases to the point where they frankly can't afford them. And so now they're faced with either reducing benefits or dropping the plan altogether, which means ends up being a situation where they threw all that money away, didn't they? I've seen this far too often, and I'm not trying to pick on long-term care insurance. I just want folks to understand what's involved. What if you had a personal bank, you're growing cash, it has the critical, chronic, terminal illness, long-term care type benefits, funds available. If that situation occurs, the monies are just there if you need it. And then if you don't need it, you didn't pay for it. So guess what? What can be better than that, right? So I talked to a lot of folks about that many times. And then the last one is the family legacy. If you're in a situation, I deal with folks all the time, the grandparents, right, who say, okay, it's not really about us anymore. It's about the next generations. Well, great. How would you like, and many of the estate planning options that are out there involve giving up control of your money while you're living to then pass on. So one of the statements I make often is, well, if you could control your money while you're living, so you have it if you need it, but yet you could pass it on tax-free, income tax-free to the heirs, up to certain limits, and there's other things we can do, of course. But if you could do that, you control your money now while you're living and then pass it on to the heirs tax-free, would that interest you? And in most cases, they're all ears. And that's what a personal bank, the policy can do. Maximize cash for you while you're living, take care of medical expenses or supplement retirement or whatever it is that your needs are. Create the positive arbitrage. By the way, what does positive arbitrage mean? It means your money's going to last longer, because if you spend it, you're still picking up 3%, right? My point is, it reduces the likelihood that you're going to run out of money in retirement and still be able to pass something on to the next generation. Contact us at yourpersonalbank.com. Let us know what your situation is. Be happy to talk to you about it and show you and educate you on how this can enhance your financial future.
For more information on Your Personal Bank, call Ference at 866-515-6280 or online at yourpersonalbank.com. Back to Your Personal Bank Show with President and Founder of Secure Estate Management, Ference Toth.
All right, we're rounding third, and hey, they're playing baseball now, so maybe life's starting to get back to normal a bit. I hope so, for all of our sakes. I've been talking a lot about the personal bank concept. If you were listening Tuesday, I talked a lot about the scenarios. There's like 7 different scenarios that I run into commonly. The reasons why somebody should look into this. If you didn't, and I talked about a little bit about that previous segments. If you missed that, go to yourpersonalbank.com. Check out the previous shows. Check them out, and you'll get more information on that. I just want to say this, I guess. My mission here on this show is pretty simple. The reason why I decided to go on the radio, the reason, frankly, I started doing workshops and webinars and things like that, 5-6 years ago, is I found that there was a chronic lack of information about how the personal bank tool could enhance folks' financial situation, whether it be the individual, business, whatever. I've shared this story many times where I I'll go into a workshop and I'll have 100 investors there, okay? And I'll ask them the question, how many are familiar with the insurance banking concept, or the different names that it's known by? And typically I'll get 2 or 3 hands out of 100. These are the folks, and understand, these are folks that are interested in learning more about money. I mean, to the tune of willing to come to a workshop and spend half a day to do so. So this isn't a cross-section of America, the average individual. This is a cross-section of folks who are actively interested in learning more about their future and learning more about money. So it's a different cross-section. You would think a much higher percentage of them would have been exposed to or introduced to or looked at this concept for their financial plan, their financial, their whole portfolio, whatever. It's pathetic, the number or percentage who have actually really looked at it. And then of the few of those were introduced to products or tools that frankly weren't the most favorable to maximize cash growth, for example, and the most efficient to make this work. As I stated, I see this all the time, and I've got a chart I got from one of the financial institutions, one of the lenders who uses this tool. They do bank lines of credit against the cash value of these policies. They've been analyzing these for 25 years. Now, again, this is a lender. They're analyzing these products, these tools. These tools are the collateral for the loans that they're issuing. So they're analyzing these really close, okay, more than most anybody else does. They're putting their money on the line, right? And there's about 12 or 15 companies, and it varies by which bank we're talking about. But in general, there's about a dozen or so companies that the lenders are comfortable lending against. Well, that should tell you something. If the lender is not comfortable with it, there's a reason. And you probably don't want to be using that. I'm not saying the company's bad or not. It's just that's not the most efficient tool to grow cash, okay? So you probably have the wrong company. Now, most of them are name brand, big name company we all are familiar with. A+, every single one of them that the banks are willing to lend against and that we work with, and I can work with just about any of them, by the way. We're independent, so I'm agnostic. Okay, I'll show you the chart that the lenders put together. This is solid gold, folks. Frankly, for years, I didn't know this even existed in terms of having a chart that could show what the dividend rates were for the different companies, particularly every single year over the last 25 years. It's tremendous. When I meet with somebody, that's the first thing I show them. Because what I want you to understand, and I want you to be comfortable with, is understand you're dealing with one of the best dividend-paying companies that exist. And be comfortable with that and understand and know what the competition out there is doing. There are 3 companies right now that are paying 6% or more. And there's 3 of them that have been paying 6% just about every single year the last 25 years in a row. Others have done that various times. But my point is I run into this all the time where I'm looking at folks getting 5, even less than 5% today, crediting on their policies. They're trying to grow cash, right? But they're only getting 5% or less. And yet they could be earning 6 or more. Okay? If you have one of those, by all means, let's talk. Contact me at yourpersonalbank.com. I'll show you the difference. We'll run numbers. We'll run a head-to-head comparison, apples to apples, and you'll see the cash difference. It's dramatic in most cases. The other thing is, when you access funds from these policies, most people, and again, we've taken the personal bank concept to another level. Or we call it your personal bank because it's not even the insurance banking concept. It's another level beyond that, and that's bringing the banking piece in. And that comes from my banking experience. I'm chairman of the board of a bank in formation, as you hear on the advertisements or whatever. We're in the process of opening a bank, and I put the two together. And there's a bank lines of credit that can you can access the funds as little as 3%. Why would you access funds from a policy where the interest rate on the loans? And by the way, when you access funds from a policy, there's a policy loan. This is one of the hang-ups people get and misunderstandings. Yes, the company credits you interest, but if you take a policy loan, they also charge you interest, loan interest, okay? And depending on the company, as I told you right now, companies are paying somewhere about 4.5% to 6% interest. That's what they're crediting, depending on the company you're dealing with. They're charging loan interest somewhere. The lowest I've seen is about 3.5%. The highest I've seen is 8%. So if you're earning somewhere about 4.5% to 6%, and you access it, and you're getting charged 3.5% to 8%, you can see real quick where, depending on your situation, you could be at best marking time. Some you're making a positive arbitrage in the policy. Most of them are marking time. In other words, you're getting paid what you're getting charged. The money's not costing you anything, which is good, but you're not really moving forward either. Or there's a number of them out there where you're getting credited one rate and you're getting charged a higher rate, so you're moving backwards. Well, again, bringing in the bank line of credit reduces the cost of the money when you access it. Now, even if you're at the 5%, let's say, and you're getting charged 3%, you're still picking up 2.2% positive arbitrage, aren't you? We'll show you how to get 6% and get charged 3%. So you make 3%. Okay? So if you have one of these policies, or you've taken a policy loan from one, the very, very least we can do is we can reduce the interest rate on your loans, which means instead of your account maybe marking time or going up slightly, or perhaps even losing, we can reverse that completely. Okay? Then we'll also look at, hey, what if we reallocated this, did a 1035 exchange, a tax-free event, things like that, if it makes sense, and get you a better rate on the growth side. You see what I'm trying to say? And also, if you just haven't really looked at this, but this is intriguing, contact us. I'll show you the chart. Again, you'll know within a minute which companies you want to work with. I work with basically all of them. So I'm agnostic, okay? Let's get you the best product, the best tool with the best rate and the growth rate, and then let's get you the best tool with the lowest cost rate to access. That's what we do for folks. And that's my mission, to get the information out there, to educate people that there's another option out there that can tremendously impact and improve your financial future. Contact us at yourpersonalbank.com. I'd be love to talk to you, share your situation, and see how we can make a difference.
This show is designed to provide accurate and authoritative information. The presenter and guests on this program do not engage in rendering legal, accounting, or tax advice. Expert advice from a professional involving your specific situation should be sought, if required. Permanent life insurance is a long-term investment. Products, optional features, and riders may have limitations, restrictions, and additional charges and may not be available in all states. Withdrawals beyond principal may be taxable income. Excessive and unpaid loans may cause the policy to lapse. If a policy lapses, unpaid loans are treated as distributions for tax purposes. Replacements may not be suitable for everyone. There may be penalties and surrender charges when replacing coverage. New products may include new surrender charges and contestability period. Policy guarantees are based upon the claims-paying ability of issuing insurance company and do not apply to the investment performance or assets in the underlying variable portfolios. The life insurance and annuity products in this presentation are not FDIC insured, may lose value, and are not bank guaranteed.